The Quant King, the life, philosophy, and secret world of Jim Simmons. Good morning. It is a privilege to be with you all once again. In our journey through the world of investing, we have explored many paths to success. We have studied the value investors who search for cigar butts and wonderful companies. We have learned from the macro traders who navigate the tides of global economics. We have listened to the activists who shake complacent boards from their slumber. All of these great minds share a common thread. They operate in the realm of human judgment. They analyze businesses, assess management, and interpret economic data. Theirs is a world of qualitative assessment, of narrative, and of reason. Today, we venture into a different dimension entirely. We are leaving the world of stories and entering the world of signals. We are stepping away from the qualitative and into the purely quantitative. Our subject today is a man who did not see the market as a place of businesses or economies, but as a vast, chaotic ocean of data, filled with faint, recurring mathematical patterns that could be decoded only by the most sophisticated scientific minds and the most powerful computers ever deployed in finance. He is a man who believed that human emotion and human judgment were not tools for success in the markets, but the very sources of the systematic inefficiencies he could exploit. He approached investing not as an art, but as a rigorous, empirical science. His name is Jim Simmons. He is a world-class mathematician, a former Cold War codebreaker, and the founder of Renaissance Technologies, the most successful, secretive, and intellectually formidable hedge fund in history. His flagship medallion fund achieved returns so high and so consistent for so long that they defy belief and dwarf the performance of every legendary investor we have discussed. His story is not one of reading annual reports or meeting with CEOs. It is a story of a scientific revolution applied to finance, of a relentless, data-driven pursuit of faint signals in an ocean of noise, and of a secretive empire built not on gut feeling or economic theory, but on the unerring, dispassionate logic of mathematics and statistics. He is the undisputed Quant King, and his career offers a masterclass in a fundamentally alien, yet profoundly successful, way of thinking about markets, risk, and the very nature of intelligence. Part 1. The Mathematician. From Code Breaking to Abstract Geometry. To understand Jim Simmons the investor, you must first understand Jim Simmons the pure scientist. He was not a product of Wall Street. He was a product of the hallowed halls of the Massachusetts Institute of Technology and the University of California, Berkeley, where he earned his PhD in mathematics at the astonishing age of 23. His early academic work resided in the rarefied air of pure abstract mathematics, specifically in differential geometry and topology, fields concerned with the properties of shapes and spaces that remain constant even when stretched or bent. In collaboration with the legendary Shen Chern, he developed the Chern-Simons theory, a profound and complex mathematical concept that would later become a cornerstone in theoretical physics, particularly in string theory and condensed matter physics. This was a mind that thought not in terms of dollars and cents, but in terms of invariants, manifolds, and underlying structures invisible to the naked eye. He was trained to find elegant, hidden order in apparent complexity. In his late 20s, he entered the clandestine world of national security, working as a codebreaker for the Institute for Defense Analyses. His mission during the Cold War was to use advanced mathematics to find patterns and break encrypted Soviet communications. This experience was profoundly formative. It trained him to think like a cryptanalyst, to treat streams of seemingly random encrypted data as puzzles containing a hidden, systematic logic waiting to be revealed by the right algorithmic key. It ingrained in him a core, operational belief beneath layers of apparent chaos and noise. There often exists a hidden, decipherable order, if only one possesses the correct analytical tools and intellectual framework. After leaving government service, reportedly due to his principled opposition to the Vietnam War, he returned to academia, becoming the chairman of the mathematics department at Stony Brook University, where he transformed it into a world-class institution. But the siren call of applying his abstract genius to the concrete high-stakes problems of the real world grew irresistible. In 1978, at the age of 40, he founded a small investment firm called Monometrics, which would later be renamed Renaissance Technologies. His initial foray was not yet the purely quantitative revolution to come. He and a few early partners, including the gifted mathematician James Axe, dabbled in currencies and commodities, using fundamental, if systematic, models. The results were solid, but not earth-shattering. For Simmons, the mathematician and scientist, this was unsatisfactory. He knew there had to be a more rigorous, more scientific, and ultimately more powerful way. Part 2. The birth of the machine. Building the Medallion Fund. The pivotal, paradigm-shifting moment for Simmons began in the late 1980s. He made a radical, intentional decision. He stopped recruiting from Wall Street and began recruiting from the world's elite universities, national laboratories, and IBM research centers. He hired physicists, astronomers, statisticians, computational linguists, and computer scientists. He was not looking for people who understood finance. He was looking for people who understood data, pattern recognition, and complex systems. This was a declaration of intellectual war on the traditional financial establishment. While Warren Buffett was building a team to assess managerial character and business modes, Jim Simmons was assembling a team to assess the statistical significance of a price move in the fifth decimal place. This eclectic band of scientists began constructing what would become the most formidable, profitable money-making machine in the annals of finance. The core philosophy was breathtakingly simple in concept, yet fiendishly difficult and expensive in execution. Financial markets are not perfectly efficient. They are driven by human beings, and human beings are biologically and psychologically prone to predictable, repetitive behavioral biases and institutional constraints. These biases, herding, overreaction, loss aversion, slow reaction to new information, create tiny, fleeting, but statistically detectable anomalies in market data. If you can identify these subtle, non-random patterns using advanced mathematics, massive computational power, and high-speed execution, you can make a microscopic profit on each trade. And if you can do this tens of thousands of times a day across hundreds of global markets, those microscopic profits, uncorrelated to each other, will compound through the sheer force of the law of large numbers into staggering, unprecedented wealth. This is the crystalline essence of the Medallion Fund's secret sauce. Let us deconstruct this revolutionary architecture. First, the foundational rejection of the efficient market hypothesis. While academia preached that markets quickly and rationally incorporated all available information, Simmons and his team started from the opposite, empirical axiom. They believed markets were inherently and perpetually inefficient precisely because they are made up of emotionally driven, cognitively limited human participants. Fear, greed, institutional mandate, and regulatory lag all create systematic and therefore predictable distortions in price movements. The market's random walk had subtle, exploitable limps. Second, the epic search for alpha through exhaustive data mining. The team at Renaissance embarked on one of the most ambitious data archaeology projects ever conceived. They gathered petabytes of historical data, not just stock prices and volumes, but every conceivable time series, satellite weather imagery, retail sales data, options volatility surfaces, macroeconomic releases, and even patterns in language from news feeds. They then deployed a staggering arsenal of sophisticated statistical techniques, from linear regression and pattern recognition to machine learning algorithms, to sift through this mountain of data in search of non-random correlations. They were not looking for a causal story, high interest rates will hurt housing stocks. They were hunting for a pure, abstract statistical signal that could predict a price movement over a very short time horizon, sometimes minutes, seconds, or even milliseconds. The why was irrelevant, the that was everything. Third, the surgical elimination of human emotion and discretion. This is the most philosophically profound pillar of the Renaissance model. Once a profitable, robust pattern was identified and codified into a self-contained trading algorithm or signal, the system would execute the trades automatically, without human intervention. There was no portfolio manager at a Bloomberg terminal, getting a gut feeling, second-guessing a position, or being paralyzed by fear during a crash. The system was a cold, dispassionate cyborg, operating on pure mathematical logic. It would buy and sell based solely on what the probabilistic data dictated, rendering it utterly immune to the psychological frailties that cripple discretionary investors. Jim Simons famously stated that one of his greatest management challenges was preventing his brilliant PhDs from overriding the models when they felt nervous or thought they saw something the model missed. He had to enforce faith in the system over individual genius. Fourth, the awesome power of short-term, high-frequency statistical arbitrage. The Medallion Fund's strategy was the antithesis of long-term investing. It was about making a vast number of small, uncorrelated, short-term bets. Each individual trade had only a slight probabilistic edge, perhaps a 50.75% chance of success versus a 49.25% chance of failure. The profit per trade was tiny, often fractions of a cent. But by making hundreds of thousands of these trades every single day across global equities, futures, currencies, and commodities, the law of large numbers transformed microscopic, uncertain edges into a torrent of certain, staggering profit. The fund's returns became as smooth and predictable as a casino's house edge, albeit a casino that had mathematically rigged every game in its favor. This high-frequency, high-volume statistical arbitrage was their unassailable moat. It was a game that required billions in intellectual capital, a technological infrastructure rivaling NASA's, and operational scale. A game virtually no other entity on Earth could hope to play. Part 3, the results. A performance that redefines the possible. The performance of the Medallion Fund is not merely legendary, it exists in a statistical category of its own, bending the curve of what was thought financially possible. From its proper inception in 1988 until it closed to all outside investors in 1993, continuing thereafter solely for Renaissance employees, the fund achieved average annual returns of approximately 66% before fees and around 39% after its jaw-dropping performance fees and expenses. To contextualize this insanity, consider that $1 invested in Medallion in 1988 would have grown to tens of thousands of dollars today, turning a modest investment into generational wealth. This staggering performance was remarkably consistent, persisting through the dot-com bubble and crash, the 2008 global financial crisis, and every other market upheaval. The fund's returns showed almost zero correlation to the broader stock market or economic cycles. It made money in sunshine and in storm, not by predicting the weather, but by trading the infinitesimal pressure changes within it. This success created wealth of a scale that transformed Simmons and his colleagues into billionaires many times over. But unparalleled success bred an equal and opposite culture of extreme secrecy. Renaissance technologies became the ultimate black box of finance. Employees signed the most draconian, non-disclosure, and non-compete agreements in the industry. The firm's methods were guarded with the intensity of state secrets. They never discussed their strategies, gave no interviews about their positions, and revealed nothing of the specific signals they traded. This secrecy was not paranoia. It was a strategic imperative for survival. Their entire business model depended on the fleeting nature of the inefficiencies they exploited. If their specific algorithms or data sources became known, legions of imitators would swarm, and the tiny statistical edges that were their lifeblood would be arbitraged into oblivion within days. Part 4. The culture of a scientific empire. The alchemists of East Setauket. The culture at Renaissance Technologies' unassuming headquarters in East Setauket, Long Island, was a world apart from the frantic trading floors of Manhattan. It felt less like a hedge fund and more like a hybrid of a university physics department, the Silicon Valley tech startup, and a classified government research lab. Simmons, as the Edison of the group, fostered an environment of intense, freewheeling intellectual collaboration and curiosity-driven research. The firm operated as a pure meritocracy of the mind. The best mathematical ideas won, regardless of academic pedigree or seniority. Simmons implemented a revolutionary compensation system where researchers shared directly in the profits generated by the specific trading strategies they developed, creating a powerful, aligned incentive for relentless innovation. The workplace was intentionally flat and non-hierarchical. There were no corner offices for star traders because there were no star traders, only star researchers and coders. This unique culture was engineered around key principles: blind data analysis. Researchers were often given anonymized, sanitized data sets to analyze, preventing their personal biases or preconceived notions about certain companies or markets from contaminating the purity of their statistical models. Relentless backtesting and out-of-sample testing, every potential trading signal was subjected to exhaustive historical testing. But more importantly, it had to hold up in out-of-sample data periods it was not trained on to prove it was a robust, persistent pattern, not a mere statistical mirage or artifact of overfitting. Radical interdisciplinary collaboration. A cosmologist might brainstorm with a machine learning expert, who would then work with a computational linguist. The cross-pollination of ideas from disparate scientific fields, from signal processing to evolutionary biology, was a critical engine of their relentless innovation. The dictatorship of data over narrative, at Renaissance. A beautifully logical story about why a trade should work was intellectually interesting but financially worthless without hard, repeatable statistical evidence. The data was the sole and supreme arbiter of truth. This was the ultimate implementation of the scientific method in finance. Part 5. The Legacy and the Lessons. What the Quant King Teaches Us. Jim Simmons retired from day-to-day management at Renaissance in 2009, turning his attention to philanthropic ventures through the Simmons Foundation. Yet his legacy looms over finance like a monolith. His journey offers profound universal lessons, even for those of us whose world will never involve a stochastic calculus model. 1. The supreme power of a truly differentiated and defensible edge. Simmons's ultimate lesson is that sustainable, extraordinary success flows from discovering and monopolizing a unique, high barrier to entry advantage. His edge was not in doing traditional analysis better. It was in applying a completely alien discipline, the hard sciences and the scientific method, to the soft science of finance. He identified an inefficiency invisible to traditional tools and built an entire fortress of intellect, technology, and scale around it. For us, this underscores the imperative to find our own genuine circle of competence and develop within it a deep, unique, and defensible expertise. 2. The primacy of process over prediction. The Renaissance empire was not built on predicting the direction of the S&P 500, the next Fed move, or a company's earnings. It was built on a robust, repeatable process that exploited statistical probabilities over a vast number of trials. This is a liberating concept for any endeavor. Instead of obsessing over being right about unpredictable macro events, focus obsessively on designing and adhering to a sound, disciplined process. A superior process, applied with unwavering consistency, will generate success over time, even if countless individual actions fail. 3. The greatest enemy is your own psychology, and systematization is its antidote. Simmons's work stands as the most powerful empirical proof that the greatest source of market inefficiency is innate human psychology. Our hardwired biases, confirmation, loss aversion, herding, are the very engines that generate the predictable price patterns his algorithms feast upon. His success is a stark, humbling reminder that to succeed, we must first become students of our own cognitive flaws. The ultimate defense against these flaws is to systematize our decision-making, to create rules that bypass emotion and enforce discipline, just as his trading codes did. 4. The courage of a first principles approach. Simmons did not accept the sacred cows of financial theory. He started from first principles, asking foundational questions. What is price data? What is its mathematical structure? What patterns can exist within it? This willingness to discard conventional wisdom and build an entirely new explanatory and operational system from the ground up was the wellspring of his revolution. We should cultivate the intellectual courage to question the accepted dogmas in our own fields. 5. The power of intellectual humility and complementary teams. Jim Simmons was a certifiable genius in mathematics, but he possessed the profound humility to know he didn't have all the answers in physics, computer science, or statistics. That is why he hired the absolute best minds in those fields and created a culture where they could thrive. He built a team where the whole was exponentially greater than the sum of its brilliant parts. This humility, the recognition that breakthrough achievements are almost always collective, is a trait shared by history's great builders. In conclusion, Jim Simons stands as a singular, revolutionary colossus in the financial universe. He was not a value investor, a growth investor, or a macro trader. He was a scientist who treated the global financial market as the ultimate complex system, his private laboratory. He demonstrated with staggering proof that beneath the seemingly random walk of security prices lies a deep mathematical order. Not a fundamental economic order, but a behavioral and structural one. And that, with the right scientific tools, that order can be decoded for monumental profit. He built not just a fund, but a new paradigm for what is intellectually and financially possible. His story is a towering testament to the power of insatiable curiosity, interdisciplinary brilliance, and the relentless, evidence-based pursuit of a hypothesis. While most of us will never use the Chern-Simons form to execute a trade, we can all learn from his example to think independently from first principles, to base our most critical decisions on evidence and process rather than emotion and narrative, and to have the vision and perseverance to build a system in investing, in business, in life that is uniquely, powerfully, and enduringly our own. The quant king may have operated in a secret world of algorithms, but the luminous lessons from his kingdom are etched clearly for all to see. Thank you.